Now we're going to get to the really exciting part where we're going to apply the Fibonacci magic to our chart. And this is where things are really going to start coming alive for you guys. Fibonacci is the most widely used tool in trading of any kind, whether it be stocks or bonds or forex, gold or oil, doesn't matter. Fibonacci is also my absolute all-time favorite tool to use in trading. And Fibonacci, when we get to the point where we put everything together, when we look at trading strategies, you'll see that the Fibonacci is the tool that I apply the most weight to when I make my trading decisions. Where do we find the Fibonacci tool? Up here in this toolbar, where we also have the time frames of the different charts. Right there, there's an icon with a tiny little F in the corner. It says draw Fibonacci retracement. Now, before we draw the Fibonacci, we have to understand what the Fibonacci should be telling us on the graph. The Fibonacci should be telling us possible turning points, either where the market is going to change direction or where the market is going to continue in its current direction. Now, as we've said before, when we look at this graph over here, for example, as well, the market never just goes boom in a straight line. It always goes with curves. It retraces and it extends and it retraces and it extends and a retrace and another extension. Sometimes the retracement is also called a correction, where the market has moved in a certain direction, there's been a certain price action, and then there's been a correction. Now, if you need more information on that, please refer again to the lecture where we deal with market swings and identifying tops and bottoms. When we apply the Fibonacci, guys, there are two very, very important rules. The first rule is whether the market is moving down or up, we always draw the Fibonacci from the left to the right, from the left to the right, from the left to the right. That's the first rule. And we only draw the Fibonacci from confirmed tops or confirmed bottoms. Again, refer to the lecture where we deal with how we identify tops and how we identify bottoms. So let me state this again. We only ever draw the Fibonacci from left to right, whether it be from a bottom to a top or from a top to a bottom. And we only ever draw the Fibonacci between confirmed tops and bottoms. That's the first rule. Never ever break that rule. Here's the second rule. The last 75 periods of any graph are the most important periods when we apply any of our indicators, especially our Fibonacci tool. Now, are we now going to individually count? Yeah, you can if you want to, but we can also use this little tool, the crosshair tool. You click on the crosshair tool and you take it to your last candle, click, hold it in, and start pulling it backwards. Now you can see the numbers change as you pull it. I'm going to pull it nice and slow. There are a few numbers that keep changing. The first number that you see, which if I stop it there for a moment, is 77. That is the candlestick count. All right? So where this crosshair is right now, That is candle number 77 from where we started over here. So that's candle number 0, and when we pull it over there, that is candle number 77. The second number that you see, the second figure that you see in the middle, is the number of points, the points difference between where the price action is there and the price action was there. Now you can see, you can draw it any which way you want. The points as they appear in the middle there are always the number of points between the center of the two crosses of our crosshair tool and the point that we drew the line from. All right? So what we want, and I'm still holding in the mouse button, by the way. The moment I let go of it, the tool disappears, and I have to go and click on it again, and I have to repeat the process, unfortunately. Now we're going to find candle number 75 or thereabouts. All right? So there we have candle 75. We know that our last 75 periods started more or less over here. Now when we draw in the Fibonacci for the last 75 periods, remember we said we always draw it from the left to the right. And in this instance, 75 periods ago, over here, the price was higher than it is now. So we will be drawing the Fibonacci downwards, measuring the length of the downward move from the highest point of the 75 periods to the lowest point of the 75 periods. We don't draw it from candle 75 to the current candle. No. We find the highest point in that 75 period, or we find the lowest point in that 75 period. Now, have a look at something here. Our 75 periods candle starts more or less over here. But we can see that this is not a confirmed top. Our last confirmed top of any significance was over there. And that is close enough to the 75 periods, guys. So we're going to click on the Fibonacci tool. We're going to, and this is a tip for you guys, the Fibonacci tool automatically snaps into the perfect position. So make sure that the crosshairs of the Fibonacci tool is exactly on the candle and as close to the wick of the candle as you can get it. When you click, you hold and you draw down to the bottom candle over there and you release, and you can see that it snapped perfectly into position at the top there and perfectly into position at the bottom there. Now this is where the wonderful, wonderful magic starts kicking in, guys. As we explained in the theoretical part of this lecture, Fibonacci gives us certain levels that also apply to human psychology. But over time, we figured out that the market reacts slightly differently, and there are certain levels of the Fibonacci. Remember, these are the levels. These yellow lines are the levels. So what this Fibonacci retracement is telling us is that when the market started moving downwards from that point over there and reached this point over here, where the market turned back, these levels are giving us the likely levels where the market might then find resistance. Remember when we spoke about support and resistance? This is another way to look at a possible resistance level or a possible support level. Now we've learned that these levels differ ever so slightly in the market. You can keep the default levels as they are over here. There's absolutely nothing wrong with that. But I do suggest that you adjust the levels ever so slightly. We see here a 236, a 382, a 50, and a 618. Now, what does that really mean? Just to recap, it means that this level here represents 23.6% of the entire span where we drew the Fibonacci for. If we take this entire span versus this area, then this area is 23.6% of the entire area. Does that make sense? Yes? This level here, the 38.2, or as we just normally call it, the 382, this represents 38.2% of the total area that we are covering when we drew in this Fibonacci. Similarly, this level, the 50 level, represents 50% of the price action of the entire period that we covered, and similarly the 61.8 or the 618 as we call it, also the golden ratio, if you remember from the lecture, the theoretical part of the lecture, that is your golden ratio right there. That covers 61.8% of the entire area covered by our Fibonacci that we drew in. Now, as I said, you can leave these levels as they are, but my suggestion is that you change them. It's always possible to change the parameters of your indicators, including the Fibonacci. Now, what you need to do, sometimes it's a little bit difficult, you need to point your mouse to the red dotted line representing the Fibonacci, and you'll see a little block pop up there that says Fibo, and it gives you numbers. You can either double click on that, or you must first double click on it in order to select it. Now you can see from those little white squares that it has now been selected. Once it's been selected, you right click on it and you'll see Fibo properties. Click on Fibo properties, and here we see the levels. These levels that we just spoke about over here, we can now adjust them over here. Now what I usually do is the 236 level. I don't use it. It doesn't tell me anything. It doesn't really feature in market turning points. So I simply delete that level. Boom, it's gone. The 382 level, I changed that to 33% rather than 382. So how you do that is you click, double click under level over here, and you change it to 0.33. Now you can either just double click under description, or you can hit tab. Now here under description, make sure that you also put 0.33, because that is what you will see appearing here, and you will see all the changes when we hit OK. That is what you see appearing here. So if you don't change that as well, you're going to get really confused, because your actual line is going to be sitting at 33%, but your label for the line is still going to be 38.2%. It's going to be really confusing. Now the golden ratio we change as well, and double click over there. We change this to 66%, 0.66. 0.66, and double click under description. Oh my word, what am I doing? 0.66. Right? Ready? Click OK. And here we see the lines have moved ever so slightly. And now we see there's our 66%, our 50% is still there, and our 33% is right over there. Now, what does the Fibonacci do for us, guys? Look at this. In this larger movement that we've traced out over more or less the last 75%, the last 75 periods, the market, when it found its bottom over there and started correcting or retracing, found resistance at the 50% level. Now, I will show you with more examples that happens a lot, guys. It happens a lot. And that is why the 50% level is so important with Fibonacci's. And this is why Fibonacci is such a magical tool to use. Now, each one of these levels can be a resistance level if the market is correcting upwards, or it can be a support level if the market should be correcting downwards. Now, each level, as the market goes through that level, the likelihood of it remaining a mere correction and not becoming a trend change becomes weaker and weaker. If the market found resistance at the 33% level and formed a confirmed high, we would have known that would have been a very strong trend continuation. Similarly, at the 50%. Now, what we usually find is that the market forms a top, or in the case of the converse direction, a bottom, somewhere between the 33 and the 50%. It's not always necessarily smack on those levels, but somewhere between the 33 and the 50%, if we see a top or a bottom forming back into the original direction of the market. As we can see, it's been trading down for a long time, so we would have waited for a top in this case to form somewhere between the 33 and the 50% to know that the market is now ready to continue in its original direction and that this correction has now come to an end. And in this case, it happened to be smack on the 50%. Sometimes the market forms a top just between the 50 and the 66%. That, however, is already a weaker top in that it now becomes less likely that this is a correction, and it becomes more likely that it could be a change in direction. Anything above this area between the 50 and the 66 is in all probability going to lead to a change in market direction. Anything above the 66 level, if the market should go beyond the 66 level without forming a top, we know that the probability of us now dealing with a trend change is very high. The probability has now become very high that the market is actually going to go into a bullish pattern and continue in that bullish pattern. But in this case, the market formed a top right at the 50% level, and we now know that it was indeed a resistance level. Again, refer to the lecture where we speak about tops and bottoms and how to determine them. And we can see that there was also a candlestick formation that confirmed that this was indeed a resistance level and that the market is indeed pulling back from it. Again, refer to the candlesticks formation lecture, and you'll see that we actually have a bearish engulfer right there forming from the 50% and engulfing the previous bullish candle. And it is an outside period candle, if you'll remember, which is a very strong indication that a top is indeed forming, that the market did indeed find resistance at this level and is now going to continue in its original bearish direction. That is how we use the Fibonacci in the case where we want to determine a trend continuation. Now, we've now found our possible entry point for a sell order in this case. We found our possible entry point, but now what? Now what do we do? Where do we place our stop loss, for example? Where do we place our take profit? What are we going to do with this information? And this is what makes the Fibonacci so fantastic. The Fibonacci is the most reliable tool that we have in order to help us work that out. Right. What we've drawn here is what is called the Fibonacci retracement. We wanted to see where the market retraced to, corrected to, right? Now we know that a top has formed, and we know that the market is continuing its bearish trend. Now we need to draw in a different Fibonacci. Now we need to know the percentages and the levels pertaining to the last confirmed move, pertaining to this correction, this retracement. This is now what we are interested in. We have now seen what we wanted to see with, let's call it the bigger Fibonacci, the larger period Fibonacci. We're done with it now. We're going to hit backspace and we're going to get rid of it. We're going to take the Fibonacci again, and remember the rule, always draw the Fibonacci from the left to the right. We now want to see what the levels will be for this move over here. So we're going to start our Fibonacci over there at the bottom and drag it all the way to the top. And now we don't have a Fibonacci retracement anymore. Now we have a Fibonacci extension, which we're now going to use to look at where to enter the market if we want to enter, and where to take profit. Now this is probably one of the most accurate and the safest trading methods out there ever. Now you'll see we don't see anything at the bottom here chart-wise. It's very easy to fix. Remember when we spoke about how to use your MT4 platform? Click on the price action area, hold your mouse down and drag it downwards, and it'll narrow the page, the screen, and you'll start seeing more levels appear. Right. Does something look familiar? 618, but in this case a 1618. This tells us that with the strength of this movement that we had here, the one that we measured, once that breaches its own 100% level, the probability is quite high that it will reach the 161.8 level over here, and that is where we will take our profit. That is take profit 101. Take profit 102 will follow when we do the strategies lecture, where we put everything together, and then I'll tell you how to actually trade. But this is the theoretical part of how we use the Fibonacci and what the Fibonacci tells us. So in this case, the Fibonacci would say, or the trading rule around the Fibonacci would say, enter at the 100%, which is there, and exit at the 161.8 level there. Take your profit there. Now, I've had these questions, guys. Please just get the terminology right. In this case, we will not be buying. We will be selling, because the 1618 level is below the 100% level. We will be placing a sell stop order. All right. I'm going to recap, guys, because the use of the Fibonacci is so incredibly important. I'm going to do a very quick recap. I'm just going to delete the last Fibonacci that I drew in, and I'm just going to stretch out the chart again. Remember, we said we look at the last, some technical analysts look at the last 100 periods, some say 75 periods, some say 150 periods. So somewhere around the 75 period, where you can find a nice confirmed top or a nice confirmed bottom, that is what you then take into consideration. Again, we use our crosshair tool. We come to the last candle and we simply click and pull it backwards. Why isn't doing it anything? There we go. We simply click and draw it backwards. You can see there 75 candles back over there. That one's the confirmed top. So we draw our Fibonacci retracement, and we see the expected reaction at the 50% level, the very strong candlestick confirmation, and the market is now moving downwards. What we did now is we drew in a Fibonacci retracement because we wanted to see what happens with this retracement. When do we draw this in? Once we see a confirmed bottom. We could have drawn this Fibonacci in once we've identified this bottom already, and then we would have waited. We would have waited to see, does the market bounce on the 33% level? Does it go through? We saw it going through. We wait some more. Does it bounce on the 50% level? Does it bounce somewhere between the 33 and the 50% level? Only once we have a confirmed top, in this case, indicating to us that this retracement has now come to an end and the market is going to continue in its original direction, only then we can now use the Fibonacci extension, where we draw the Fibonacci from the low to the high, and in order to see the lines in the cases where we can't, we simply click and drag down, and here we see the Fibonacci extensions, the extension to the 1618, the 2618, and there is even the last one being the 423.6. But that kind of trade is not for you guys, trust me. It's safer for you to get out at the 1618 level. But that we will cover when we do our complete trading strategies. That was the use of the Fibonacci tool in trying to find a trend continuation trade. Now, what do we do when we see that the trend isn't continuing? It simply isn't continuing. It's changing. Remember when we spoke about the trend identification, we focused very strongly on a trend is your friend until it ends. One way of determining if a trend is going to end is this. When we no longer have a higher high or a higher low. If all of a sudden we have a lower high or we have a higher low, we know that the trend is changing, which is what happened over here. Can you see here, guys? We have a low over here. The market retraced and then did not form a lower low. In fact, this was a warning to us that the market might now be changing direction. This is the first condition, is that we no longer have a lower low in a downtrend or a higher high in an uptrend. That's the first warning. It's the first condition that has to be met for a trend to change. Now we need to start saying, hang on, this trend might not be our friend anymore. This trend might now end. And then we need to prepare for it. And the best way of preparing for it is what? The Fibonacci. So now we see, hold on a second, we have a confirmed bottom over here, which is higher than the previous bottom. Aha! Let us prepare. Now, how do we prepare? It's very simple. After this bottom, there had to be a what? A top. And there was the top, the confirmed top. After the top, there had to be a bottom. So, we have a top, we have a bottom. That means that we can use the Fibonacci tool by connecting those two. So now we look at the distance between the top that formed after the lowest low and the higher low. So we will draw the Fibonacci in from there to there in order to see if there is a possibility for us to trade in a changing trend. Now the rule says that when we have a higher low, we also have to have a higher high. That high was higher than that high. That is a trend change. In this specific instance, to be very blunt with you, if you traded this, you would have lost money. Why? Because you would have entered the market at the 100, at this level over here, buying, and your take profit would have been placed at the 1618. Your stop loss would have been placed at the 0. You can see that the market did not reach the 1618. In fact, it went down and it will have taken you out at a loss unless you followed the secret little method which I'm going to teach you in the trading strategies component of this course. But this is how we use the Fibonacci when we try and see when there's an expected trend change. This is not my favorite way of using the Fibonacci. My favorite way of using it is in a trend continuation. Now you can see in this trend continuation where the trend just remained our friend all the way through, we had so many opportunities to use the Fibonacci tool, it's not even real. If we wanted to see if the market, after this correction, after this retracement, if it then dipped below this low that we have there, where will it have gone to? Fibonacci would have told us. Boom! We will have entered the market over there. On the 1618, we will have exited the market. And we will have taken our profit. Similarly, the next move, which is this one over here. We now have a new bottom. We have a new top. And there we go. We will have entered the market over there. We will have placed our stop loss over there. And we will have put our take profit at the 1618 level. And we will have made our profit. So 1, 2, 3, 4 times in a row, we will have profited by using the Fibonacci tool. This is why I'm so excited about this tool, guys. And we can see in this instance the market even dipped and touched the 2618. And you will really be smiling when we get to the trading strategy part about how to prepare to trade all the way down to the 2618 if the market does go there. So we will have profited in this case not just that number of points, we will have profited that number of points. And so on, and so on, and so on. Guys, I can carry on and on and on about the Fibonacci for days because it is such a wonderful, fantastic tool. And that's exactly what it is. It's a tool. It's not a trick. It's not a trading robot. It's a mathematical certainty. It is a mathematical, factual statement. It is what it is, and it has been around ever since trading itself. It's been around before trading, as we saw in the theoretical part. The Fibonacci tool has to form part of every single trader's trading strategy. Without it, forget it. Because Fibonacci was one clever Italian. That concludes this lecture. I hope you enjoyed it as much as I enjoyed presenting it. And I look forward to welcoming you to our next lecture. Until then, have a great day.